We can see the stocks that Nvidia buys and sells through their public filings with the US SEC, and as they are a publicly traded company, they're required to disclose certain information about their investments, including stock purchases and sales in filings such as the 13F form, which we can see in front of us today. Now, this is a form that is filed quarterly by institutional investment managers who manage over $100 million in assets, and it lists the securities they hold, including stocks, and is publicly accessible as we have right now, and it also provides transparency about the company's portfolio and their trading activities. Now, this was the most recent form we had from Nvidia, where they had Applied Digital Corporation, ARM Holdings, Nano-X Imaging, Recursion Pharmaceuticals, Serve Robotics, and SoundHound AI in their portfolio, and just released yesterday we have the updated form where we can see some changes. Now, there are a few companies they've sold out of, in fact one that is a new position that we are going to cover today. We're going to cover each one of them in today's episode. Now, the first company that they have actually fully sold out of was Serve Robotics. Now, this company develops autonomous sidewalk delivery robots designed to transport food and small goods in urban areas, and it was originally a spin-off from Uber's Postmates. The company focuses on sustainable, efficient, and contactless last-mile delivery. Now, their AI-powered robots navigate sidewalks, avoid obstacles, and operate with minimal human intervention, and Serve Robotics partners with food delivery services and restaurants to enhance delivery speed and reduce costs. Now, if we look at the company after the announcement, we can in fact notice it was down around 40%, and we can see the movement. In fact, looking at the 52-week range, what a range indeed. $1.77 at the lower end, at the upper end $37, and right now trading at the $14 mark. Now, Wall Street actually give this company a strong buy. That is a 5 out of 5. Not one we have actually ever seen on the channel, so very interesting to know. Clearly, Nvidia didn't want to hold this company anymore, and if we were to take a look at the earnings, first thing that we really want to point out, as you can see, in fact, each one of these are negative, so they are yet to turn a profit. Earnings per share, in fact, anticipated to continue the negative trend, and whilst December 2024, the EPS was around negative 0.99 cents, December 2025, still the anticipation of a negative EPS, sitting somewhere around the negative 62-cent mark. So we do want to make you aware, and therefore we are unable to look at the PE on a non-GAAP basis like we typically do, but you can see, based on the EV to sales, based on the price to sales, this is a company that is trading at a significant valuation, but again, Wall Street do believe this is one for consideration. In terms of the growth, the only metric we have here is that the year-on-year revenue is up 692%, and it's clearly a lot stronger than the sector right now at 2.3. We can also show you the profitability with the gross margin at 13.4%, quite low when you compare it. The sector median is higher at 38%, and the cash from operations, maybe no surprises given the negative EPS, is negative 19 million, meaning right now at the early stages of this company they are burning through cash negative 19 million, when the sector in comparison is actually making around 279. Now, we're not going to do our typical analysis of companies where we run it through our own valuation process. As you can see, these companies are yet to turn a profit. They are very small in terms of the market cap, but one thing we will show you is what the analysts expect, and we can see Serve Robotics, there is a price target for around $23, which they do see around 66% upside, and that is over the next 12 months. As always, give us your thoughts. Maybe these are companies that actually you're invested in, maybe they're on your watch list, or for whatever reason they're not ones you are considering. The next company they fully sold out of was SoundHound AI. Now, they specialize in voice recognition and conversational AI technology, enabling businesses to integrate advanced voice assistants to their products. Their technology is used in automotive, hospitality, and customer service industries for hands-free voice interactions, and the company does compete with major players like Google Assistant and Amazon Alexa by offering customizable voice AI solutions. Now, very similar to the previous company, on the announcement that Nvidia fully sold out, their price was down around 28%, but over the last year they still have had a very strong performance, up 386%, now trading in the mid to low end of the 52-week range, quite a pullback from their all-time highs of around $25, and we do note here Wall Street have given this company a buy rating. In terms of looking at their earnings, again, very similar considerations to have here. Not only have they missed 3 of the 4 earnings, 25% record, we can see every single quarter is negative EPS. Having said that though, they do expect EPS to increase from negative 38 last year to negative 0.25. Now we do have these same considerations as the previous company in that it is difficult to look at the valuation based on the forward PE, but if you look at other ones like the EV to sales, price to book, we do get quite a significant premium, in fact massively higher than the sector comparative. Obviously, if a company does in fact grow at a much faster rate, you could argue a premium is worth it. Whether or not this much of a premium is something for consideration. Year-on-year revenue, 76%. Forward-looking, 74%, which is clearly above the sector at the mid-single digit rate. If we take a look at the company in terms of profitability, they get a D. Gross margin, 61%, actually a lot better than the sector of 51%. But when we come to look at their cash from operations, they have also been burning through a lot of cash, negative 90 million, sector comparative at 98 positive. In terms of what the analysts believe, they see this at $24 over the next year, and that equates to 119% upside. So definitely one you could argue to think about. Just because Nvidia is fully selling out of these positions doesn't mean it isn't a good stock to consider in your portfolio, but as always, give us your thoughts. The other position they have fully sold out of is Nano-X imaging, and they develop innovative medical imaging technologies focusing on digital X-ray systems, with their flagship product being a radiation-free imaging platform that aims to provide safer and more efficient diagnostic imaging, and the company uses nanotechnology to enhance image quality whilst reducing exposure to radiation. They also seek to make medical imaging more accessible as well as affordable globally. In terms of the company, well, again, down 11% on the news of Nvidia fully selling out, and they're up only 6% over the last year, trading at the lower end of the 52-week range with a strong buy rating, another 5 out of 5 for Wall Street, something that for us is unheard of. And when we take a look at their earnings, 50% track record over the last year, although the most recent 2 misses were only marginal by 1 cent, and out of the next 4 quarters, 3 of them expected growth, in fact those 3 at double digit, yet we do notice negative EPS expected for the full year of 2025 at negative 71 cents. In terms of valuation, they get a C-, same considerations, you can take a look, but equally this is trading at a massive premium. We're talking around 900% nearly, purely on a price to sales just over the last 12 months. And when we look at their growth grade at a C, 11%, actually not that far off the sector at 7.6. However, next year is anticipated to be a very strong year, 52%, sector comparative at 6.8. In terms of profitability, they get a D-, gross margin very poor, negative 88%, sector comparative at 59, and the cash this company generates from operations, probably no surprise that it is negative, with in fact the sector also being negative, although to a smaller degree. If we take a look at what the analysts believe, well, their price target over the next year is $15, and we can clearly see triple-digit growth expected at 128%. Now, before we continue, we want to let you know we have just released our latest free weekly article. We drop one every single Monday morning where we cover severely undervalued stocks for your attention, as well as what's going on in the market over the last few days. So click below, you can sign up, read straight away, where you'll be able to gain access to 45 undervalued stocks for the month of February. Lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that you can grab another spreadsheet of 32 stocks that Wall Street themselves believe have the most upside right now in the S&P 500. So click below, you can sign up and read straight away. Then we move on to a company that in fact Nvidia have added, that is WeRide Incorporated, a China-based autonomy driving company developing level 4 self-driving technology for various applications, including robo-taxis, robo-buses, and autonomous delivery vehicles. They use AI and advanced sensor fusion to enable safe and efficient autonomous mobility, and they partner with automotive manufacturers and ride-hailing services to deploy their technology at a scale, with their goal to revolutionize transportation with fully autonomous driverless solutions. Taking a look at the company, on this announcement of Nvidia, shares are up 84%, Year to date up triple digit 122, trading in the mid to upper end of the 52-week range, with Wall Street calling this company a buy. In terms of their earnings, well, we don't actually have the release of any yet, but we can in fact see for this full year, no surprises, like all the other companies, negative earnings per share, negative 0.36, and they expect revenue to be 141 million for 2025, a significant jump from the previous year at 62 million. In terms of the valuation, again, very difficult to come to an answer, but in comparison to other valuation metrics, it is trading at a very sizable premium. If we look at their growth, well, year on year, we have negative 19%, but as we saw into 2025, we are expecting a triple digit jump. And in terms of their profitability, 37% gross margin, pretty much in line with the sector, and their cash from operations, as we can see, another company that is burning through cash, negative 80 million, with the comparative at 279 million. Now, interestingly, the first one we have covered today, where Wall Street actually see downside, their price target $22, and this equates to around 31% over the next year. Now moving on to companies they still hold in their portfolio. The first one, Applied Digital, which designs and operates high performance data centers optimized for AI, cloud computing and blockchain applications. The company focuses on energy efficient infrastructures to support large scale computing needs. Their facilities cater to enterprises requiring high power, low latency environments, and they aim to provide scalable solutions for AI model training, data processing, and decentralized computing. If we look at the company, we can see they're up around 15%. Over the last year, up 93%, now trading in the upper end of the 52-week range, with Wall Street giving them a strong buy. If we take a look, again, negative earnings, and as you can in fact see, over the next full year, EPS expected to be negative 56 cents. And when we get to the valuation at a C-, a massive premium again. And whilst the answer is still the same, we do want to show you for transparency so you can see the exact figures. In terms of growth, they get a B. Nice to see 85% and 90% year on year and forward looking respectively, with the sector comparative in the mid-single digit. And then we get to the profitability where they get an F. Gross margin 2%, sector significantly higher at 51%. Bottom line negative, not a great sign, sector at 4%, and no surprises here, cash from operations burning through negative 123 million, sector at 98 plus. Wall Street themselves see this around $13 by the end of the year, equating to 42% upside. We then move on to ARM Holdings, which designs energy efficient semiconductor architectures using a wide range of devices, from smartphones to data centers. Their chip designs powers most of the world's mobile processors and are licensed by companies like Apple, Qualcomm, and Nvidia, and they focus on innovation in AI and high performance computing. They also play a crucial role in shaping the future of low power, high efficiency computing. In terms of looking at the performance, well, they're up around 26% over the last year, trading in the mid to upper end of the 52-week range with a buy rating from Wall Street. If we look at their earnings, well, the first one today that actually is reporting positive EPS. Over the next 4 quarters, growth expected. Nice to see a 100% historical track record, and based on March 2026, we can see their forward P comes in at just over 78. No surprises, still they get an F given the fact the sector does sit significantly lower, so if you're buying this company, you are paying around a 289% premium. In terms of growth, A-, year on year 26%, sector around 5. If we then look at the EPS expected growth, 31%, sector comparative at 14.9, but you could argue maybe that isn't enough to justify the very huge premium. In terms of profitability, it sits at a B+, gross margin incredibly high, 96%, sector at 51, bottom line 22%, sector at 4, and we can see cash from operations a very healthy 806 million, sector 98. In terms of Wall Street, they see this at $179 by the end of the year, equating to just over 12% upside. We then move on to Nebius Group, headquartered in Amsterdam, providing AI-centric cloud infrastructure and services for developers. Now, emerging from the international operations of Yandex, Nebius focuses on building large-scale GPU clusters and cloud platforms to support intensive AI workloads, and in December last year, they raised $700 million from investors including Nvidia and Acel to expand their AI infrastructure, particularly in the US. They also encompass subsidiaries like Toloka and WeRide and TripleTen, which specialize in data solutions, autonomous driving technology, and in fact educational. The company over the last 12 months up 134%, pretty much right now trading at the upper end of the 52-week range, with a double strong buy from Seeking Alpha and Quant and a healthy buy from Wall Street themselves. We also get negative EPS, in fact expected over the next full year at negative 79, and then when we come to the valuation, they actually get a B. We do notice some metrics that do look favorable for them in terms of the EV to sales, EV to EBITDA, as well as the price to sales and price to book. In terms of looking at the company from a growth perspective, at a B-, 13% year on year, sector at 5.14, not looking good over the next 12 months, negative 54%, sector at 6.3, but we do anticipate free cash flow to grow at the triple digit rate, 316%, significantly higher than the 18 of the sector comparative. Profitability, they get a C-, gross margin 55%, higher than the sector at 51%, bottom line negative 7%, sector comparative at 4%, but what we do like is they do generate cash in a positive way, 786 million over the last year, a lot higher than the comparative of 98 million. Now analysts see this at $51 over the next full year, which does equate to 15% upside. We then move on to Recursion Pharmaceuticals, which uses AI and machine learning to accelerate drug discovery and development. They integrate automation, data science, and biological research to identify new treatments faster than traditional methods. Their platform analyzes vast amounts of cellular data to uncover potential drug candidates. They also aim to revolutionize pharmaceutical research by making drug discovery more efficient as well as scalable. As we can see, up 24%. In fact, over the last year though, they are down around 4%. Right now trading pretty much bang in the middle of the 52-week range, with a hold from Seeking Alpha, Wall Street, as well as Quant. In terms of earnings, well, negative again. In fact, it is expected to get worse, down to negative 164 over this full year. And if we look at their valuation at a C, not looking great. They are trading at a very, very significant premium, pretty much consistently whichever valuation metric you look at. In terms of growth, they do get a B. Year-on-year revenue 38%, forward-looking 28%, a lot better than the sector comparative at the mid to high single-digit point. And then we get onto their profitability at a C+. In terms of cash from operations, this is a company that burns through cash quite a significant amount, negative 318, although we do notice to a much smaller degree the sector with the same but negative 15. In terms of price target, analysts expect around the $10 mark, which when we do translate that means downside of 2% over the next year. As always, give us your thoughts below. Don't forget to sign up to the free weekly newsletter, grab those spreadsheets, and come and join us on Patreon where we do cover our weekly buys and sells. We have been making buys and sells over the last few weeks given the volatility, and have a great day. We'll see you all on the next one.